Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Business Economics. In this lecture, we'll begin with Chapter 3, that is Theory of Production and Cost, and in particular, we'll begin with Unit 2, that is Theory of Cost. We had already done Theory of Production, that is Unit 1. All the concepts will be covered in the coming series of lectures. So let us begin. This is lecture number 7, Theory of Cost. Let's see the learning outcomes of this chapter. At the end of this unit, we'll be able to understand the meaning and different types of cost, meaning of cost and different types of cost. We will be able to define cost function and explain the difference between short run and long run cost function. We'll try to explain the linkage between the production function and cost function, explain economies and diseconomies of scale and reasons for their existence. Let's see the intro. In the previous chapter, we have discussed the relationship between inputs and outputs in physical quantities. However, as we are aware, business decisions are generally based on cost of production, that is, the money value of inputs and outputs is considered. Cost analysis refers to the study of behavior of cost in relation to one or more production criteria. Namely, the criteria are size of the unit, scale of operation, prices of factor of production, and other relevant economic variables. In other words, cost analysis is concerned with the financial aspect of production relations as against physical aspect which were considered in production analysis. In order to have a clear understanding of cost function, it is important for the businessman to understand the various concepts of cost. Let us begin with the first concept of cost, and that is accounting cost and economic cost. Accounting cost and economic cost. What is accounting cost? We can say that accounting cost is the explicit cost. Accounting cost is the explicit cost. Economic cost is explicit cost plus implicit cost. An entrepreneur has to pay price for the factor of production which he employ for production. Thus, he pay wages to workers, prices of raw materials, fuel, power used, rent for building he hires, and interest on the money borrowed for doing business. All these are included in the cost of production and are termed as accounting cost. Why? Because all these costs are explicit cost. We are paying the money to somebody else, which is outside the organization. Accounting costs relate to those costs which involve cash payments outside the organization by an entrepreneur of the firm. Thus, accounting costs are explicit cost and includes all the payments and charges made by an entrepreneur to the supplier of various productive factors. Accounting costs are expenses already incurred by the firm. Accountants record these in the financial statements of the firm. Financial statements over here means income statement and statement of financial position. Income statement and statement of financial position. However, It generally happens that an entrepreneur invests a certain amount of capital in his business. If the capital invested by the entrepreneur in the business has been invested elsewhere, we must have got some interest. I'll quote some example. Suppose there is an entrepreneur who is investing 5 lakh rupees in his business. That means what? That supposingly he had not invested this 5 lakh rupees in his business and done fixed deposit of 5 lakh rupees at the rate of 10%, he must have received 50,000 rupees per year as an interest on those 5 lakh rupees. If the capital invested by the entrepreneur in his business has been invested somewhere else, it would have earned a certain amount of interest or dividend. Moreover, an entrepreneur may devote his time because he personally work in this organization. So work of production and contributes his entrepreneurial and managerial skills and ability in the business. Had he not set up his own business, he would have sold his services to somebody else and he must have received some salary in terms of his services because he used to work in that company. Accounting costs do not include these costs. These costs are basically implicit cost. Implicit cost. The entrepreneur has given the his services, his managerial skills, his creativity he has utilized, or the family members are working inside the organization. These costs are implicit cost. Thus, economic cost include A. The normal return on money capital invested by the entrepreneur himself in his own business, that is implicit cost, and wages and salaries not paid to the entrepreneur but could have been earned if the services has been sold to somewhere else. Likewise, the monetary rewards for all factors owned by the entrepreneur himself and employed by him in his own business are also considered a part of economic cost only. That means that economic costs take into account these accounting costs. In addition, they also take into account the amount of money the entrepreneur could have earned if he had invested in his money and sold his own services or factor to the next best alternative use. We are talking about opportunity cost over here. Opportunity cost. Accounting costs are also called explicit cost, whereas the cost of factor owned by the entrepreneur himself and employed in his own business is called implicit cost. Thus, economic cost include both explicit cost, that is accounting cost, and implicit cost. Therefore, economic costs are useful for business well while making decisions. Only accounting cost does not with only accounting cost, the entrepreneur can't reach to any conclusions. The concept of economic cost is important because the entrepreneur must cover his economic cost if he wants to earn a normal profit. Normal profit is a part of implicit cost. If the total revenue earned by an entrepreneur to just cover the implicit and explicit cost, that means he is only reached the break even and not making profit. Then he has zero economic profits and reached to just break even point. Supernormal profit or positive economic profits, or we can say that abnormal profits, are over and above the normal profits. In other words, entrepreneur is said to be earning positive economic profits, that is abnormal profit, only when his revenues is greater than the cost. Revenue is greater than cost. This is a situation of abnormal profit. I believe it is clear to all of you. Just write a quick meaning of implicit cost over here. Implicit cost. So implicit cost include what? Land owned by entrepreneur and used for business purpose. Used for business purpose on which no rent is paid. Obviously, he will not pay rent to himself only. So, land. Number two, wages or salaries, wages or salary not paid to the entrepreneur, to the entrepreneur, but could have been earned, could have been earned if his services, his services has been sold somewhere else. That is, if he were employed in another firm. Okay. Third point, normal return on money capital invested by entrepreneur himself in his own business. This is also a part of implicit cost. This is also a part of implicit cost. Let us continue now. Let's try to understand the next concept, and that is outlay cost or opportunity cost. Outlay cost or opportunity cost. Over here, we can say that opportunity cost refers to basically the value of sacrifice made or benefit or opportunity foregone in accepting an alternative course of action. The opportunity lost is the opportunity cost. You can write opportunity cost refers to the value of sacrifice made or benefit lost or foregone, benefit of opportunity foregone in accepting an alternate course of action is known as an opportunity cost. Outlay cost involve actual expenditure of funds, say wages, materials, rent, interest, etc. We pay wages to laborers, we raw material, rent for land, and interest for capital. Opportunity cost, on the other hand, is concerned with the cost of the next best alternative opportunity which has foregone in order to pursue a certain action. It is the cost of the missed opportunity, the opportunity lost. And involves a comparison between the policy that was chosen and the policy that was rejected. For instance, the opportunity cost of using capital is the interest that it can earn in the next best use with equal risk. A distinction between outlay cost and opportunity cost can be drawn on the basis of nature of sacrifice. Outlay cost involves financial expenditure at some point of time and hence are recorded in the books of accounts. Opportunity cost is the amount of subjective value that has foregone in choosing one activity over the other, the next best alternative or activity available. It relates to sacrifice alternative. It is in general not recorded in the books of accounts. So opportunity cost is not recorded in the books of account because actually we have not paid anything. But yes, because we have accepted one alternative, we have also sacrificed one alternative. The opportunity cost concept is generally used or useful for business managers, and therefore it has to be considered whenever resources are scarce and decision involving choice of one option over the others is to be made. In a cloth mill, just an example, which spins its own yarn, the opportunity cost of yarn to be weaving department is the price at which the yarn could be sold. Because we are using our own yarn, that means we are not buying the yarn from outside. This has to be considered while measuring profitability also of the weaving operation. I believe you understood till here. In long term cost calculations, also opportunity cost is a very useful concept. While calculating the cost of higher education, it is not the tuition fee or the cost of books alone that is important or relevant. One should also take into account the earnings foregone, other foregone uses of money which is paid as tuition fees, and value of missed activities as the cost of attending classes. Have you understood? So this was about opportunity cost. Just write one small example in relation to opportunity cost over here. A person quits his job. A person quits his job and enters into business. Here, the salary foregone, the salary foregone from employment constitutes an opportunity cost. And opportunity cost. Okay? Let's see direct cost and indirect cost. That is traceable cost and non-traceable cost. Direct cost is a cost which could be directly associated with the product, and non-traceable cost or indirect cost is the cost which cannot be directly associated with the product but it is a part of the cost. Direct costs are those which have direct relationship with the component of operations like manufacturing a product, organizing a process or activity. Since such costs are directly related to the product, process or machine, they may vary according to the changes occupying in these. Direct costs are costs that are readily identifiable and traceable in a particular product, operation or plant. Even overhead cost can be direct as to a department. Manufacturing cost can be direct to a product line, sales territory, customer class. We must know the purpose of cost calculation before considering whether a cost is direct or indirect. Okay, so right over here, direct cost, they are directly charged, they are directly charged to the product, operation or plant, as they can be directly identifiable. Indirect cost, indirect cost, they are apportioned or absorbed over different products or departments using appropriate basis. Let's see. Indirect costs are those which are not easily identifiable in relation to plant, product or process or department. Therefore, we can say that such costs are not visibly traceable to specific goods or services, but nevertheless charged to different jobs or products in standard economic practice. The economic importance of these costs is that these, even though not directly traceable to a product, may bear some functional relationship to production and may vary changes between output in some definite way. Examples of such costs are electric power. We consume electricity, but you can't associate that which product has consumed which electricity, how much electricity. And common cost, the housekeeping or cleaning cost, incurred in general operations of the business benefiting all the products jointly, the apportionment is not possible at all. The apportionment of these costs is not possible at all because these are not quantifiable, but still they have some functional relationship to production. Let us continue and see incremental cost and sunk cost. Incremental cost and sunk cost. So incremental cost, we can say that refers to the additional cost incurred by a firm as a result of any business decisions. Sunk cost is something which is different, which cannot be recovered. Like research and development cost could be treated as sunk cost because you had done the research and development. Now, whether there could be some benefit because of that research, that's great. But if there is no benefit out because of that research, you can't do anything because that cost is sunk cost that can't be recovered now. Theoretically, increment costs are related to concept of marginal cost, additional cost. Additional cost. Incremental cost refers to the additional cost incurred by the firm as a result of business decision. For example, incremental cost will have to be incurred by a firm when it makes a decision to change its product line, replace worn out machinery, buy a new production facility, or acquire a new set of clients. Sunk cost refers to those costs which are already incurred once and for all it cannot be recovered now. It cannot be recovered. They are based on past commitments and cannot be revised or reversed if the firm wishes to do so. Examples of sunk cost could be the expenses incurred on research and development, expenses incurred on advertising. Supposingly because of the advertising there is no benefit to the organization. Still you can't recover this cost back. Specialized equipment and fixed facilities such as railway lines, sunk cost act as an important barrier to entry of firm into the business because there is no possibility of recovery. I believe you understood the meaning of sunk cost. Right over here, sunk cost refers to those costs which are already incurred but cannot be recovered, can't be recovered. For incremental you can write incremental cost refers to the additional cost incurred by a firm as a result of business decision, normal business decision. Understood? Let us continue. Historical cost and replacement cost. The next cost is historical cost and replacement cost. Historical cost is basically the cost incurred in past somewhere on the acquisition of some productive assets like either machinery or building. In case of replacement cost, you can say that replacement cost is the money expenditure that has to be incurred for replacing an old asset which we have already used. So historical cost refers to cost incurred in the past on the acquisition of any productive asset such as machinery, building, etc. Replacement cost is the money expenditure has to be incurred in replacing an old asset. Instability in prices make these two costs differ. Other things remaining the same, an increase in the price will make replacement cost higher than historical cost. You can write here historical cost are already incurred in the past. They are not useful for current or future decisions. The next concept is private cost or social cost. Private cost or social cost. So private cost basically the cost of production incurred and provided for by any individual firm engaged in the production of a commodity, and social cost is cost to the society. So we can say that the cost of producing a commodity to the society as a whole. It takes into consideration all those costs which are borne by the society directly or indirectly. Like we done pollution to the society, that will act as a cost. Let's continue. So private costs are costs that actually incurred or provided for by firms and are either explicit cost or implicit cost. They normally figure in business decisions as they form part of total cost and are internalized by the firm. Social cost, on the other hand, refers to the total cost borne by the society on account of the business activity and includes private cost and external cost. It includes the cost of resources for which the firm is not required to pay price, such as atmosphere, river, roadways, but everything is included in the cost. Social cost and cost in terms of disutility created, such as air, water pollution, and environment pollution. Understood? So you can write over here social cost equals private cost plus external cost. For private cost, you can write explicit cost and implicit cost. And implicit cost. Private cost is found out to calculate private profits. Private profits. If I talk about social cost is found out to calculate social profits social profits rather than private profits. Rather than private profits. Private profits. Let us continue and see fixed and variable cost. The meaning of fixed cost and the meaning of variable cost. Fixed cost and variable cost. If I talk about fixed cost, then fixed cost is a cost which remains fixed up to a certain output or level of activity is achieved. But if I talk about the variable cost, these are costs that vary, that changes based on the level of output. So as the level of output will increase, the variable cost will increase, and as the level of output will decrease, the variable cost will decrease automatically. Fixed or constant costs are not a function of output. They do not change with the output when the level of activity changes. These costs require a fixed expenditure of funds irrespective of the level of output. Whether the level of output is low or high, but fixed cost remains same, but up to a certain level of activity. Supposingly, there is a machine which produce which maximum the maximum capacity of machine is 1000 units. Suppose you had produced 1 unit or you produce 1000 unit, the fixed cost would be same. I believe you understood. Fixed cost is machine, the price of machine which is fixed. Continue. Example, rent, property tax, interest, loans, depreciation, when taken the function of time and not the output. However, these costs may vary by the size of the plant and functions of capacity. Therefore, fixed costs do not vary with the volume of output within a capacity level. The capacity is 1000. So till 1000 capacity, supposingly I am paying rent of this machinery. The rent of this machinery is 1 lakh rupees. Whether you produce 1 unit or you produce 1000 unit, the rent cost of this machine is 1 lakh. This will be fixed cost. I think we are clear. Fixed cost cannot be avoided at all. These costs are fixed so long as operations are going on. Till the time you are doing manufacturing, the fixed cost is same. They can be avoided only when the operations are completely closed down and there is no need of machinery. These are by their nature inescapable or uncontrollable cost. But there are some costs which will continue even after the operations are suspended. For example, for storing of old machines which cannot be sold in the market. These are called shutdown cost. Some of the fixed costs such as cost of advertising, program fixed cost or discretionary expenses because they depend upon the discretion of the management whether to spend on these services or not, and that is why they are known as discretionary expenses. Let's see variable cost. So variable cost are the costs that are functions of output in the production period. For example, wages of casual laborers and cost of raw materials and cost of all other inputs that changes with output are variable cost. So supposingly we are increasing the output or decreasing the output, and along with the increase or decrease in output, the raw material cost is changing, the oiling cost, greasing cost, maintenance cost of machinery. So variable cost directly sometimes proportionally with the output over certain range of production, they may vary less or more than proportionately depending upon the utilization of fixed facilities of resources during the production process. So this was about fixed cost and variable cost. You can write over here some portion of fixed cost cannot be avoided even when operations are suspended. even when operations are suspended. But in case of variable cost are avoidable cost as it is incurred only when production takes place. When production takes place. Understood? Let's move to the next concept, and that talks about cost function. Cost function. So basically, cost function refers to, we can say that, mathematical relationship between cost of a product and its various determinants of cost. In a cost function, the dependent variable is cost unit or total cost, and the independent variable is price of the factor. Price of the factor is independent variable, it is uncontrollable. The size of the output or any other relevant phenomena which has a bearing of cost, such as technology, the level of capacity utilization, efficiency, time period under consideration. Cost function is the function which is obtained from production function and market supply of inputs. It expresses the relationship between cost and output. Cost function are derived from actual cost data and are presented through cost curves. The shape of the cost curve depends upon the cost function. Cost function are of two kinds: short run cost function and long run cost function. Short run cost function and long run cost function. In cost function, you can write dependent variable. What are the dependent variables? Total cost, unit cost, or output cost. These all are the dependent variable. Now we have independent variable. Independent variable. This could be size of output, scale of operations, price of factor of production, so on. I believe you understood till here. Let us continue and see short run total cost. Let us continue and see short run total cost. Total cost, fixed cost, and variable cost. Total cost, fixed cost, and variable cost. There are some factors which can be easily adjusted with change in the level of output. A firm can readily employ more workers if he has to increase outputs because workers are available. Similarly, it can purchase more raw materials also if he has to expand the production. Such factors can be easily changed, varied with the change in the level of output, called variable factors. On the other hand, there are some factors such as building, capital equipment, top management which cannot be easily changed or varied. It requires comparatively longer time to make some changes in them. It makes time to install new machinery. Similarly, it takes time to build a new factory also. Such factors which cannot be readily varied or changed and require a longer period to adjust are called fixed factors. These are called fixed factors. Corresponding to the distinction between variable and fixed factor, we distinguish between short run and long run periods of time. Short run is a period of time in which output can be increased or decreased by changing only variable factors. Fixed factor cannot be changed in short run, such as we can change labor, we can change the availability of raw materials in short run. Quantities of fixed factor cannot be changed. You can't bring a lot of money, a lot of capital, a big machinery in a day. You won't be able to manage that in accordance with the change in output. If the firm wants to increase the output in short run, it can do so by increasing the variable factors only. That is, by using more labor and buying more raw materials. Thus, short run is a period of time in which only variable factor of production can be varied, while the quantities of fixed factor remain unaltered, unchanged. On the other hand, long run is a period of time in which all the factors may be changed. You can change fixed factors as well as variable factors. Can be altered, can be changed in long run. All the factors become variable in the long run. See this diagram which represents the fixed cost. Completely fixed cost, total fixed cost. This cost is fixed whatever is the level of output. Level of output is 100 units, still the fixed cost is fixed. Or it is 300 units, still it is fixed. Example, just write over here, rent of machinery or rent of factory. Okay. Let's move ahead now and see this variable cost. Variable cost. So total variable cost is plotted on the y-axis. On the x-axis, completely variable cost. Students, you can see it over here. With the increase in output, when output is 100, the variable cost is 10. When output increased to 150, this also increased to 15. When output increased to 400, it also increased to 40. So you can say that fixed cost is directly proportional to output. Fixed cost is directly related to or directly proportional to output. When you can say that variable cost is directly proportional to output. That means what? That when there would be a positive change in the output, when the output will increase, the variable cost will also increase, and when the output will fall, the variable cost will also fall. Variable cost will increase when the output will increase, and variable cost will fall when the output will fall. Understood? Let's see this. Thus, we find that fixed costs are the costs which are independent of output. Whether the output is more or less, fixed cost will be the same. They do not change with the change in output. These costs are fixed amount which are incurred by the firm in the short run, whether the output is small or large. Even if the firm closes down for some time, in the short run, the fixed cost remains the same. Fixed costs include the charges of contractual rent, insurance fee, maintenance cost, property tax, interest on capital employed, manager's salary, watchman's wages. The fixed cost curve is presented in figure 5 over here. Let us continue. Variable cost, on the other hand, are those costs which changes with the changes in output. These costs include payments such as wages of casual laborers. So when there would be less output, less casual laborers will be brought into the company. Prices of raw materials, when there would be less production, less raw material will be used, and accordingly fuel and power used, transportation cost, etc. If a firm shuts down for the short period, it may not be used the variable factor of production and therefore will not therefore incur any variable cost. Figure 6 represent the variable cost above. The assumption is that variable costs change linearly with change in output. Just see it over here. This is variable cost. Let us continue. Now see semi-variable cost. Semi-variable cost. Now you can see, students, over here, this is a fixed component of cost. This is a fixed component of cost. So up to a certain limit, the fixed cost is here. So say for example, fixed cost is 100, and after this point, the fixed cost will be stagnant and the variable component of the cost will start. That means what? When the output will increase, the variable cost will increase. So this cost is known as semi-variable cost or semi-fixed cost. Why? Because over here there would be an element of fixed cost as well as variable cost, both. Both the element of fixed and variable cost is present over here, and that is why it is known as semi-fixed cost or semi-variable cost. So semi-variable cost equal to fixed cost plus variable cost. Some component of fixed cost and some component of variable cost. There are some costs which are neither perfectly variable nor absolutely fixed in relation to the changes in size of output. They are known as semi-variable cost. The example given over here is electricity. In electricity, generally there is a fixed element of meter rent. Whether you use the electricity or not, you have to pay meter rent. That is a fixed charge. And when you use the electricity, when you consume the electricity, that is a variable component. So you can say that electricity is a semi-variable cost, because whether you don't use electricity, you have to pay the fixed charge because you had taken the connection of electricity. If you will use it, you also have to pay the variable charge. So fixed charge also and variable charge also will be incurred by you. So the electricity is semi-variable cost. There are some costs which may increase in a stair-step fashion. They remain fixed over a certain range of output, but suddenly jump to a new higher level when output goes beyond a certain limit. Examples are cost incurred towards salary of foreman will have a sudden jump if another foreman is appointed when the output crossed a particular limit. So supposingly we need one foreman for 1000 units. The 1000 units, till 1000 units, this would be same. But once there would be more than 1000 units, supposingly we had started producing 1020 unit, we need one more foreman over here, and the cost will automatically increase. I believe you understood. Just see it over here. This is stair step variable cost. For a particular range, it will be fixed and then it will be variable. If you have understood this, we can move ahead now. Let us see this short run total cost curve. Short run total cost curve. So we can say that total cost curve or total cost equal to total fixed cost plus total variable cost. Total fixed cost plus total variable cost equals total cost, or total fixed cost curve equal to total cost curve equal to total fixed cost curve plus total variable cost curve equals to total cost curve. On the x-axis we have plotted output, that is in units, cost, that is in rupees on y-axis. You can see this is the fixed cost. Up to this limit, the fixed cost is stagnant. So say for example it is 100. It is fixed. Whatever is the level of output, this cost is fixed. Now this cost is variable. Total variable cost. Total variable cost. That means what? When the output increases, this cost will increase. When output increase, this cost will automatically increase. This means what? That we have to calculate total cost, and total cost is the summation of total fixed cost plus total variable cost. So we can say that total cost equal to total fixed cost plus total variable cost. So if I want to make total cost curve, I have to start from here, this point, this is point P. From here I have to start making total cost curve. Total cost curve can't be started from 0. I believe you understood this. Let us see the text now. The total cost of a business is defined as the actual cost that must be incurred for producing a given quantity of output. The short run total cost is composed of two major elements, namely total fixed cost and total variable cost. Symbolically, it is shown as TC equal to TFC plus TVC. We may represent the total cost, total variable cost and total fixed cost diagrammatically. You had seen in figure 9. In the above diagram, the total fixed cost TFC is a horizontal line parallel to x-axis. You can see it's a horizontal line parallel to x-axis. As TFC remains fixed for the whole range of output, the curve starts from a point on the y-axis, meaning thereby the fixed cost will be incurred even when the output is 0. On the other hand, the total variable cost curve rises upward, indicating that the output increases, the total variable cost increases. The total variable cost curve starts from the origin because variable costs are 0 when the output is 0. Variable cost is 0 when the output is 0. It should be noted that over here, total variable cost initially increases at a decreasing rate and then increasing at an increasing rate because the output is increasing. This pattern of change in the TVC occurs due to the operation of law of increasing and law of diminishing returns to the variable inputs. Due to this operation of diminishing return, as output changes, the larger quantity of variable inputs is required to produce the same quantity of output. Consequently, we can say that the variable cost curve is steeper as higher level of output and the total cost curve has been obtained by vertical, the total fixed cost curve and total variable cost curve. The slope of total cost and total variable cost is same at every level of output at each point of time. The two curves have vertical distance equals to fixed total cost. This position, its position reflect the amount of fixed cost as well as slope reflects to variable cost. So you can see students over here, this distance and this distance would be common because the distance between total variable cost and total cost is because of the total fixed cost. We keep this lecture till here only. I hope you had understood it well. We stop here, and what we will do in the next lecture, we'll resume from this point only. Thank you all. Thank you.